So what's up? Let's do the trading basic call. So I'm gonna go over with you guys today about what's trading, why trading, what should you keep in mind, potential in trading, win-loss boundaries or stop loss and take profit, as we're gonna call it. What platform should you trade on? What are bullish and bearish trends, currency strength, what is a pip and what is a lot? So basically, what is trading? It's pretty simple. This website you see right here is the main analysis website you're going to use in the future, as well as the one on the I'm Center, the impulse scanner, or whatever strategy you're going to use. So basically what you can trade is you can trade currency pairs like you did do when you travel somewhere else in like Europe. So you can trade all those different currency pairs, as you can see here, euro, US dollar, for example. And what trading really means is the financial markets that you can trade on, which are the Forex markets, so the foreign exchange market, the crypto market, which are Bitcoin, Ethereum, and all those kind of things, and then also the stock market. Those are like the major markets you can trade on. Now I closed my window. You still see my window?
Yeah, we can see it.
Okay, good. And then just to give you some perspective on what the potential is and why trading, the Forex market is a 6.6 trillion dollar a day market. Where is it at? Here. So this is an old statistic from 2019. So, you know, it breaks up 6.6 trillion every single day. So if you don't know how much a trillion is, it's 12 zeros. So, which is pretty crazy. And why trading? Well, usually you put your money with the banks. And the crazy thing is the biggest market participants in the Forex market, for example, are the banks. This statistic from June 2020 show you that the biggest participants in the market for a month, you know, were JP Morgan, which is a big bank, UBS, German bank, Citibank, Goldman Sachs, all of those institutions, you know, participate in the daily market every day. So if you think of it, 6.6 trillion, they make up 10% of that, which is pretty crazy in a whole month. So if you want to calculate it the right way, 6.6 times 20 is 132 trillion every month. So JP Morgan, for example, makes 13 trillion every month of that volume in the market, just to give you a little perspective. So why trading? Because the banks are doing it anyway with your money. If you have your money on your bank account, the banks use your money to trade so that they can generate a profit. And that's why it makes sense to send your money to work instead of just trading time versus money. What should you keep in mind? What's really important with trading is that, you know, there's risk involved. You need to work on proper risk management, because if you can win money, you can also lose money. But I'm going to go over that a little bit later, how to work around risk to reward management. And also what you should keep in mind is to get a system, a strategy. So kind of like a rule book that you use to analyze the market, to check off the boxes before you enter a trade. The potential in trading, well, it's pretty much limitless, you could say. But what's really, really important about it is that, you know, you compound your money. So if you want to see how it works, well, there's compound interest calculators. And you can literally look it up anytime you want to. So let's go with the Forex compounding here. Let's say we start off with 1,000 euros and we do 5%. Let's go with 10%. Let's say you do 10% every month. We're going to run that for 6 years. You're not going to take out any money. You're not going to pay in any money, just to show you what's possible with it. And this is the table. So, you know, in the beginning, it doesn't seem like a lot. You would start making 100 euros, 10, 21, so on, so on. After a full year, you grew your account from 1,000 to 3,000. Doesn't seem pretty big, but the potential behind it is if you do it another year, you already grew your account to almost 10,000 euros. So making 10% every month is like a part-time income for a lot of people. Like if you think about it, you make 1,000 euros every month, and then after the third year, you hit 30,000. Fourth year, it's almost 100,000. And that's when you make 5 figures every month trading. And then after 5 years, you're at 300,000. And after 6 years, you're almost at 1 million euros. So that's the potential behind trading, because Albert Einstein said the compound interest is like the 8th world wonder. So this is why trading makes sense and what the potential in trading is. Next thing is win and loss boundaries. So when you enter a trade and you take a trade, that what you should keep in mind, that there's 2 things that you can do with trading. You can either have a long position where you buy when the currency is rising. Oh, let me delete that again. You make money betting on that the currency exchange rate is rising, and you have a stop loss and a take profit. So in the middle here, you see your entry price. You have a goal in mind. So let's say you have that the market's coming here, and the bottom line is the stop loss. So your loss boundary, you set it not for the amount of money that you, let's say, you want to risk. You would set it depending on the market situation that comes with the strategy, but you define that this market, like this part of the trade, only is worth, let's say, 1% of your money. And then the market could go down and then up to hit your take profit. This is like the goal where you analyze the market to go. And trading is all about probabilities and predictions. So, it's not gambling, but you have probabilities that you look at, and you look at different options. And it's about reoccurring structures in the market. So this is what we use to analyze a market and indicate whether it goes up or if it goes down. So you always look at the 2 of the things. And then the same thing for the other side is if you would sell a currency, you would have your stop loss in the other direction and your take profit to the downside. So you make money when the market, the exchange rate is dropping. And then the same thing, the market can move anywhere in here until it hits one of the borders, or you close the trade. So those are the loss boundaries. Let me just delete that drawing quick again. And then what platforms should you trade on? Well, there's different brokers. I'm not the person to recommend to you a broker. You can do your own research for that and just type in Forex brokers. There's a lot of big ones. What's really important that you have to think about is, let me put an arrow quick. If you choose and pick a broker, you would have to look at the details of the broker. So what's the commission the broker takes for each trade? Then spread. Spread is something in price. I will go over that when we talk about a pip as well. And then also leverage, because trading is a leveraged market. You take your 100 euros, and if you would have a leverage of 1-to-1, you would only be able to move trades as big as your account, so 100 euros. So a leverage, for example, 1-to-100, gives you the opportunity to invest 100 euros into your bank account, but move as much money on the market as if you would have 10,000 on your account. And then also payout options. How can you get your money out of the account again? And securities. So some brokers are regulated, some are not. Some have banks behind them so that your money is secure in case of the broker going bankrupt or something like that. So those are things that you need to look up if you want to find a good broker. Now, I talked about it that you can buy or sell a currency. So you have bullish and bearish trends, so upwards and downwards trends. And pretty much what that means is, I'm going to make this a little bit bolder in a second here. So this would be a bullish trend. Let me make it bold. And a bullish trend consists of a follow-up of a higher high. And then usually the market always corrects itself to the downside, creating a low point. But this is not the point that indicates that we're still in an upwards trend. You want the market to continue going higher than the previous higher high, forming a new higher high. And now you can identify the low point, which is the higher low. This might sound a little confusing in the beginning, but pretty much this is how the market always cycles. It's always a cycle of that. If you just look at a line chart, we can look at the market in a second as well. This is always what reoccurs. So you always, if you look for an upwards trend, spot the higher high. So this is one. Spot the next higher high to spot if we're still in an upwards trend. And then you can identify your low. So this is the bullish trend or upwards trend. So how do you spot if a market is turning around? Pretty much the same way, just the other way around. And I'm going to change the color. So you have the market drop and creating lower low, a lower high, a lower low, lower high, and continues. Let me make this red real quick so that we identify this better. So let's copy this over here. So we have our higher low of the previous sequence, right? So to identify that the market is dropping and turning around, you wait for the market to cross below the previous, let's just make this yellow so everybody sees, previous higher low. So then you know, okay, we're going into a downwards trend, which consists of a lower low. And then it's pretty much the same thing, just reversed. You wait for the market to drop lower again, below the lower low that we had. And then you can identify your lower high. And this is pretty much how the market always continues. This is pretty much how the market always goes. There's different concepts that call it differently and the phases in between, but pretty much this is how you can define how the market looks like always. So this is what you look for in trading. If a market is trending in one direction, you want to go with the trend because the trend is your friend. Pretty funny rhyme, but it is what it is. Like if the market is continuing to going up, you don't want to sell in the middle here because it's going to continue to go up. So you always want to look for the turning points to get in and can go with the continuation of a trend. That's why a strategy is so important, to learn the rules on how to enter each trade. Then currency strength goes right with this topic. So you have the currency, and if the euro, for example, in this case, is stronger than the US dollar, we're going up. So if the currency in the front is stronger, the trend is bullish, or we have upwards momentum, you could say. Oh, maybe I should do it this. So this is what you can keep in mind for if the trends going up, the front currency is stronger. And then if the back currency, so in this example, the US dollar, if the currency in the back is stronger, the trend is bearish, or we have a downwards momentum. So what you can think of is, okay, so stronger currency means that that's some economic factors that go in. Let's say you see down here we have news. This is what like the little indicator for news on TradingView. So you see that we have a news coming out tomorrow for the US dollar, and we have a forecast and how it was previously. Let's say this is really bad news for the dollar. So this weakens the dollar. Then the US dollar is weaker than the euro, and the trend would go up because the euro is stronger. The currency in the front would be stronger. So it means that the economy behind this currency is stronger, and news always come out, and it's a little bit more supported. What you can always do to check currency strength is either you go to the impulse scanner, which is the strategy we're all going to trade on mostly. So if you're not sure about a currency strength, down here, I don't know, let me comment it right here, you see the strength. So in this case, the Australian dollar is weaker than the Canadian dollar because the strength is pointing downwards. So Canadian dollar is 47, the strength of it. So it's stronger than the Australian dollar. So this is what you always need to keep in mind. And there's also a website like Currency Strength Meter to always have an indication of how strong a currency is. Let me just erase this. So this currency strength meter shows you right now the Australian dollar is weak, Canadian dollar is strong, Switzerland franc is pretty weak, the euro is weak, British pound is weak, Japanese yen is like in the middle field, New Zealand dollar is a little bit above average, and US dollar is really strong. So if we look at the euro US dollar chart, you can see, and let's put this to a line so you can see a little bit better. You see that the euro is weaker than the dollar. The dollar is strong because the currency exchange rate is dropping. Right now, $1 is worth $1 is worth 98. No, the other way around. $1, if you have €1, you get 97 US dollar cents. Sorry. So the dollar is stronger. That's pretty much what it means. So you can always check things like that to do that. Then how do you know how you make money, or how is it measured? When you go to the grocery store, the gas station, if you see a price, it's only 2 decimals, 2 numbers behind the comma, right? In the financial markets, you have 4 and an uppercase 5th number. The 4th number for most currency pairs, and I'm going to write it down here in a second. What is a pip? So the pip is a measurement tool. In the financial markets. And for most currencies, it's the 4th decimal. If somebody doesn't know what a decimal is, I'm just gonna write it out. 4th number behind the comma. So every time the 6 moves to, let's say, a 5 or a 7, the currency changed by 1 pip. This is how you measure how big of a movement, how big your trade was. So we measure everything in pips. So whenever you open up a trade, let me just put it in here. So every time you have this, you see, okay, we have 100 pips up here and 30 pips down below. This is like how you measure how big your trade is going to be. So this correlates with your risk management a lot, and also correlates with how much money you can make, because you can decide with something called a lot how much a pip is worth. So let's go over what is a lot or lot size. You have something in your trading app whenever you enter a trade that you define on how much money you're actually moving in the market. And it defines how much worth is a pip. So in US dollar, for example, or euro. So the smallest lot size is called a micro lot. And when you type it in on your trading app, you're going to see it like this, 0.01. This means you move, I think it was 1,000 units on the market. And a pip would be worth 0.1 dollars, so 10 cents. Then the next, you can do this, so 0.02 would mean a pip is worth 20 cents. So you can go incrementally up by 10-cent steps. The next bigger one is a mini lot, and you move, if I recall it right, 10,000 units in the market. A pip would be worth $1 per pip. And then the next biggest one is a standard lot, which is 1.0. It's 100,000 units in the market. And the pip is worth $10. With the units in the market, I always say this because that's when the leverage comes in place. If you trade with a €100 account, you don't just move your €100 in the market, because it's just, like I said, it's a $6.6 trillion a day market. Your €100 wouldn't do much. So that's why the brokers give you leverage. And with the smallest lot size, you move 1,000 on the market instead of maybe 100, or let's say you risk 1%, so €1. So that's why the units behind it. It's a little bit deeper, but just so you know what a pip is worth. The smallest lot size, 10 cents. The next bigger step is $1 per pip. And then the biggest one is $10 per pip. You can increase this. You can go to a 10 lot size and would be $100 per pip. This is roundabout. This is something you can just keep in mind as a reminder. The real value of a pip, you can always go to websites like MyFXbook, and the real value of a pip depends on different things. So for US dollar currencies, all the pairs that are with US dollar, you know, the micro lot is worth 10 cents, the mini lot $1, the standard lot $10. And then obviously, because of the exchange rate, everything is measured in dollars. It varies from currency pair to currency pair. As you can see, Australian dollar in New Zealand, it would just be 5 cents per pip, 50 cents, 56 cents, $5.60. So this is something you need to keep in mind when trading, that you use something called a lot size calculator, or position size calculator. You can just keep what I just showed you here in mind if you just want to go into a quick trade. But if you want to be detailed and want to be sure about something, you use something called a lot size calculator. So let's say we want to trade British pound, Australian dollar. Our account currency is euro. We have 1,000 euros in our account. We want to risk 1%, and let's say we have a 30 pip stop loss, and the trade size is always 1 down here. You hit calculate, and you risk 10 euros it would be 5,198 units, and it would be 0.05 lots. So that's why a calculator is always a good thing, because if we switch it up now to British pound, Japanese yen, we keep all the parameters the same. We want to risk 10 euros. You know, we have a 30 pip stop loss. You see that the lot size change, it doesn't really change, but the units change. Here it can't change because 0.05 is the smallest. You can't put in 0.048. So if we would have 10,000, you see that it's different. So that's why the smallest lot size can just go in 10-cent steps, and what's what you have to keep in mind. But just to show you the difference in different currency pairs, you're still just risking 10%, 1%, but the lot size changes for each currency pair. And this is something, that's why something like this, like a tool, is really, really important. Let's do another one. Let's do Switzerland francs and Japanese yen. Okay, that's the same lot. Let's do Australian dollar. There you see. This is a good example. Australian dollar, Switzerland francs. Australian dollar, Japanese yen is a lot of 0.5 and we risk 100. Australian dollar, Switzerland francs is still, we risk 100, but the lot size changes. So this is something, a tool that you're gonna always use to not overtrade your account, because it's really important that you have a good lot size, because risk management is the most important thing. And here's a quick example. So let's say we have 1,000 euros in our account. And let's say we risk, let's go with a little bit higher risk so everybody understands. We risk 3% per trade of our money. We aim for 9% take profit. So this would be 30 euros, and this would be 90 euros. Let's say we start trading. We have 10 trades that we're going to trade this week. So let's say we lose the first 7 trades in a week. And that means we lost 210 euros, right? So we're down 210. Most people would quit, but that's why risk management is important, because if you know you have proper risk management, it doesn't matter, because we still have 3 trades left. So let's say we win the last 3 trades this week. We won 270 euros. Overall profit is 60 euros, which is 6% gain on our 1,000 euros. So even though we lost 7 trades, we still up. We lost 7 trades, 1 to 3 trades this week, we're still up. That's why risk management is so important. And what you will find out is you need to have a certain thing, a couple of things to really go on with this. So what do you need to go on this journey? Learn the basics. That's the first. Either this video, if you watch the recording, or the boot camps that are on Go Live. So this is like the first thing that you really need to do. Then pick a strategy. We recommend to trade the same strategy as us. The majority, so impulse. And then write down the rules of when do I enter a trade? How much should I risk? And I'll explain this by time as well. Then when do I exit my trade? How big is my take profit and my stop loss? So you have a rule, like you write down the rules, and this is going to be like your Bible when it comes to trading. And then the last thing, what you need to keep in mind is learn emotional intelligence. I don't know, you guys can write in the chat, what do you think are the biggest enemies in the markets? The biggest enemies in trading. Your own emotions, exactly. Do you know which emotions? Anger, yes, that's a good one. Afraid, sad, joy, and anger. Yep, that's all good ones. So anger, joy, feeling sad. So you can't trade out of anger. Let's say you lost the 7 trades. You can't trade out of revenge. You still need to follow your rules, because you can sum it up as greed, to be greedy, to have more, and the fear of missing out. FOMO. You probably all heard it when crypto was on a hype. FOMO. If the trade is, you didn't take the, like you didn't hit the trade, and the trade is the currency is going the way you want it to go, don't FOMO in. Don't try to catch the train when it's already gone. Like you can try run after a train. If it's already running, you're not going to get on the train. Why do we do that? Like, why do we realize that in real life? But when it comes to trading and investing, people still think like people bought Bitcoin at 40,000 and then it dropped. Why get on when it's too late? Wait for a new entry. And greed will be like, even if you won the trades, you know, set yourself a limit for when it's enough. When do I stop trading for today? Either you set a limit for loss a day, or also a limit for wins a day. Oh, we would call it losses then. So let's say you made, let's put this here quick. Let's say you lost 5% or 4% that day. You stop trading. Let's say you made 4% that day. You stop trading. Why risk more? If you have a good day in trading, it's good. The best trade you can take is when you take no trade. And that's where I would stop the recording. This is, I think, a lot of information for the basics. So I would stop the recording, and then you will hear the rest in new calls or in the boot camp. So thanks for watching the recording. If you have any questions, feel free to reach out to anybody in the team, and then we'll get you going.